All right, well, let's jump right into the first question here. The first question that was asked of us is, what is YCG's 3-year outlook for the market and our strategy?
Yeah, and so I'll take this one. So unfortunately, our crystal ball is totally broken, and as has been demonstrated in countless studies, everyone else's is as well. So the fact of the matter is, it's just the future is radically unpredictable, and no one can predict it. I mean, just look at what happened like the last couple of years. We had a pandemic. Then everyone thought we were going to go into like a global Great Depression. Then we got vaccines, we got huge stimulus, and then people thought we were going into the roaring 20s. And now people, feel like we're in this horrible stagflationary period potentially. And just looking at like one thing that was sort of super crazy is, oil prices went during the bottom of the pandemic to negative $40 per share. And then today they're over $100 a share. So the point is, we just don't know what's going to happen in the future, but just because you can't predict what's going to happen doesn't mean you can't prepare. And so we've studied multiple periods of, like low interest rate environments, rising interest rate environments, stagflations, recessions, depressions. And that's, and we've just tried to design a strategy that can maintain and grow our purchasing power in a wide range of economic scenarios. And like we were mentioning earlier, that means owning this diversified collection of these global champions that, for instance, in an inflation, can raise their prices, but because they provide these valuable services, such as, selling cosmetics that people covet, or selling, infrastructure like MasterCard and Visa, or like Amazon with AWS, or Microsoft with software that people need to be productive. Sort of no matter what people are trading money in, people are willing to trade a portion of their time for those services. And so Brian already mentioned L'Oreal as an example. And then the other thing I would just mention about the downturn in stocks and the rise in the cost of capital that we're currently experiencing is that sometimes bad economic periods are actually a blessing in disguise for truly great dominant companies, because even though they're not fun, the businesses are able to, even though they're hurting, all of their smaller, less dominant competitors are hurting way, way worse. And so many of them go out of business or are able to be purchased as distressed competitors, or, businesses also, they can exercise some untapped pricing power during downturns that maybe they felt like they couldn't in good times or didn't need to. Also, a lot of times businesses during good times, get a little, they spend a little bit too much on kind of too far-flung activities. And so then in bad times, they really sort of tighten up the belt. And then when they come out of the bad times, a lot of times it takes a while for them to actually feel free with money again. And so the businesses can kind of come out of the downturns with much stronger market positions, much higher margins, and sometimes even better growth. And so anyway, those would just be a couple comments.
I'm sure that all the clients are hearing a lot about stagflation or reading a lot about stagflation, which is just simply the concept that you have low growth and inflation at the same time. So prices are going up, but after you strip out inflation, you're in either just low growth to no growth, or maybe even a recession. And to Elliott's point, like, nobody can guarantee us that we know that stagflation will happen. If I had to be a betting man, like, we can make the predictions of what we think, but as Elliott pointed out, there's so many unpredictable things. And so, but if stagflation is what you're reading about, what you're concerned about, which is the strong narrative of today, I think we've created a portfolio that's prepared for that, because pricing power is the best thing you can do to help raise prices and maintain your margins during a period of high inflation.
Thanks, guys. As a follow-up to that, Rich is asking, or Sally, This economy is based on the consumer. As long as we are at full employment, the economy should be strong. As rates rise, do you think unemployment will rise, slowing the economy? Thoughts on that?
Well, again, I would come back to, it depends, like that it's super unpredictable. So yes, that in general you would think as rates rise, what you can typically expect is that rates rise, which means as things get more costly, like borrowing, money to be able to get a home gets more difficult. Cost of capital gets more pricey, which means prices in general, like everything, costs go up, right? And so then that puts the brakes on the economy, slows things down, and then that could lead to an increase in unemployment, and then slows down inflation, and then you find this equilibrium. But the problem is that there's so many moving factors. Like the economy is so diverse in so many variables that one instance of just raising rates has one effect, but that leads to other effects, which leads to the second degree and the third degree and the fourth degree knockoff effects. And then you want to study history to understand what's happened, but even that won't be a perfect guide, because markets are a lot like a biology, where they like a living organism that learns from itself. And so what worked in that one environment, humans may learn and adapt in the future and behave differently. And that different behavior leads to a totally different outcome. And so again, I just think, yeah, it's possible, it depends, but none of those things as we think or study them change the way that we're trying to figure out. Ultimately, we just want to have a portfolio that's robust against many outcomes so that in the long run, it works out.
Yeah. And I would just say, like we're hearing lots of stories about, like Amazon, Walmart, Target, they all probably overbuild capacity and have too many people. And so maybe they're laying off people. So they're probably going to be laying off people. A lot of tech companies are laying off people. But on the other hand, a lot of mortgage brokers are laying off people. But on the other hand, the oil and gas industry with prices where they are, they're probably hiring as fast as they can. Also, we've had a sort of unique
sector.
Right. Yeah. And also we've had the travel sector, everyone's kind of moving from goods spending to services spending. So services economy, maybe hiring a bunch. So it's just, again, sort of the economy is too big, too complex, too diverse. And so we kind of try to just narrow in on what are the key factors for a company to be able to grow its earnings power and keep earning excess returns in a wide variety of environments.
All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos and we'll see you next time.